So now you're probably like, damn, that's a lot of text. But don't you worry. The reason why there's so much text is because, one, I want to begin by giving you context on what net working capital is all about. And then we can jump into understanding what the change in net working capital actually means for a business. Okay. Once we've looked at these two categories, we're while we look at those two categories, we're going to arm ourselves with two things: an Excel sheet right here and a timeline to really display what's going on between the two. All right. And once you understand this, this is the only like hard part. Okay. The only like weird part. And once you understand this, you're actually able to jump into the net working capital recapture portion. That becomes a breeze because you kind of you have like this intuitive sense of what's going on. So it's awesome. So let's get right into it. Sorry, I had to do a little burp. I'm sorry if I'm a little bit discussing right now. It's gonna be a long one. So hopefully you're still here with me. So some context on the net working capital, or just context on net working capital. The first thing that I'd like to describe, and this is something that we've seen a little bit within our Intro to Financial Accounting course, is that net working capital simply looks at current assets less your current liabilities. Okay. And I'm going to jump from this bullet point to another one because I want you to understand simply that net working capital is current assets less current liabilities. That's what you want to be able to kind of just visualize at the very beginning. This is going to be our first rule for our little net working capitals like portion. Okay, so we'll name this as A. Now let's get a quick introduction to what are current assets and why do they matter? Because once we understand that, we can move on to current liabilities, and then you really will understand what net working capital really tries to highlight. Let's go ahead. So common current assets, okay, you're looking at accounts receivables, inventory, prepaid expenses, and a bunch of other ones. But really, the main ones that you saw in your Intro to Financial Accounting class, the main ones that you will see if you go look at a financial statement for a company, will simply be, accounts receivables, inventory, maybe merchandise, and prepaid expenses. To give you some quick context on what accounts receivables and etc. actually stand for, I'll kind of like talk about them a bit. Accounts receivables, it's very straightforward. Let's say that I sold you this calculator. Okay, I sold you the calculator, but you decide to pay me at a later date, such that you are gonna owe me money, and I am expecting to receive the money that I made off this sale. I didn't receive cash instead. Okay, so if you remember our T accounts from back in the days, this would mean that, okay, 100%, my accounts receivables would be debited for, call it, I don't know, $10, and my revenues would be credited for $10, right? I created revenue because I fulfilled my service or my product or my duty to you, but I didn't receive the cash like in exchange for that. I actually received the other asset, the other current assets that we call accounts receivables. So you expect to receive cash from your customers because they paid you in nothing yet. So you're expecting to receive that money, and hopefully you expect to receive that money within the year. Hopefully that gave you a little bit of context. If not, I have a bunch of other videos on this. Now, inventory is simply all of the inventory you have at your office, at your warehouse, at your gig. So if I'm a person that sells calculators, well, I would have a bunch of calculators in inventory. So I bought 20,000 calculators in the hopes of selling them all. But until I sell them, they're only inventory. And inventory is interesting, right? Think about it. If I buy more inventory, I had to pay it in cash, okay? So I hope that's clear. I guess as we go, I'll draw like a few T accounts. If my inventory increases, okay, this would mean that I'm debiting inventory. And let's say we'll use $100, but I had to pay inventory with something. I had to pay inventory with cash, right? So that would mean that I spent $100 if I'm increasing my inventory. So now you're slowly starting to get the vibe, okay? And prepaid expenses is simply like, let's say I would buy, let's say I need to rent an office and I decide to pay all of my year's rent before I actually I'm only at month one, we're in December or we're in January, sorry, and I paid a full year's worth of rent. Well, come on now, I prepaid some expenses, okay? And for sure it's gonna give you a future benefit, but right now you spent more than what you actually used, that you actually expensed. And that's also a loss of cash, all right? So what I'm trying to highlight here is that, actually I'll keep this here, is that when you're increasing your current assets, okay? When your current assets are increasing, as you can see here, Well, it actually kind of results in a negative effect in your cash holdings. It results in a negative effect in your cash. And I mean, our example at the bottom of the screen really highlights that. If you have a increase in your inventory, which is a current asset, well, that inventory had to come from somewhere, right? You had to pay for it in cash. And if your accounts receivables are increasing, well, that means that you're not receiving cash for the sales that you're doing, okay? And all of those things are going to have effects on your financial statements. It may mean that you're overstating your income or understating your income, okay? So that's really important. So another way to look at this is that if, let's say, our accounts receivables were to decrease from one year to another, that means that people owe you less money, okay? And that would mean that if they owe you less money, it's because they paid you that money, assuming no like doubtful accounts or whatever. So that would mean that you have a positive effect on cash holdings. And that's awesome. So you kind of notice something especially if you're sharp and you remember our statement of cash flows in your intro to financial accounting class, is that, well, an increase, okay, in current assets is actually a negative effect to your cash. And that's what we highlighted in our operating activities section in our statement of cash flows. Whereas a decrease in current assets is a positive effect in cash. And that's exactly what we added in our statement of cash flows back in the days, right, in the previous course. So that's extremely, extremely important. And it'll make more sense as we proceed towards our current liabilities and as we restate what net working capital tries to highlight. But before we go there, I'm going to run through an example just to really double down on what current assets really mean for a company. Okay, so let's look at Nike. And Nike would observe a negative effect to its cash if its accounts receivables increased by $50 million from 2021 to 2022. So it had a smaller amount and now it increased, okay, by $50 million. So they're owed $50 million in accounts receivable more. So this would indicate that a portion of Nike's sales this year, right, $50 million of Nike sales this year were fulfilled. They sold the shoes, right? They sold the shirts, they sold the hoodies, but they didn't receive cash for those sales, okay? Such that if we were to look at their income statement, revenue would be high. Revenue would be high by $50 million, right? Extra, in a sense, a portion of it. But that $50 million, right, that we said that we made in revenue, that essentially we made in earnings, was actually not fulfilled in cash, okay? So we overstated the amount of cash we actually said we received by $50 million. So we're lost in terms of $50 million in cash that we don't have, okay? That's important. So in plain English, if Nike has an increase in their accounts receivables by $50 million, that means that Nike did not receive $50 million in cash, although they recognize that revenue on their income statement. And that's really what the first portion of our net working capital formula tries to highlight. Okay, very important to understand that. And of course, you could do a proof, and that's how I studied back in the days. I would always work off proofs to really understand, well, how does one thing affect all of our different statements? And if you're actually like trying to interview for like some, I don't know, like some gigs in finance or in business, you may have to actually be able to walk through these different effects on your statements. So that's important to understand. Now let's move on to common current liabilities, okay, the second portion of our net working capital formula. Now, common current liabilities, well, it's easy. It consists of accounts payables, okay, accrued liabilities, and deferred revenue. All right, it's as simple as that. Now, accounts payables, very straightforward. Let's say that because I sell calculators, I have to go find a supplier. I have to go to Texas Instruments, and I said, yo, I want to buy $20,000 worth of calculators, but I'm gonna pay you like 4 months from now, not right now, like in the future type of thing. And if I do that, that means I didn't pay them in cash. So I'll give you an example. All right. If I do that, that means I didn't pay them in cash. And I'm gonna walk through a little proof here, such that you really see it. So let's say I got inventory. I don't know why I erased it then. That's crazy. So I got an inventory of $100, okay? I got this much inventory for 100 of calculators, but I didn't pay them in cash. I actually essentially created a liability. I created an obligation towards my supplier, okay? Such that I credited accounts payable for $100, all right? Well, that's awesome though, because it means that I now work off credit, I work off debt, I work off a future obligation, but my pockets are still filled with cash. I got inventory that I could go sell for cash, and I got to not spend cash to make that money. All right, so that's awesome. That's really cool. So that would actually highlight perhaps a positive effect to our cash holdings, because typically you would need to spend $100 in this case, but we didn't. Okay. I'm just trying to be funny and trying to make some sense of it. So for sure, there are different videos out there that are more formal with formal definitions, but this is just a quick introduction. Okay. So, of course, there are some holes and some gaps here, but if we look at accrued liabilities is just another form to discuss all the different types of payables you may have. For example, interest payable, or for example, wages payable, or salaries payable, et cetera, et cetera. That's just a different name that we could kind of call our accrued liabilities, okay? So same framework that we've applied to our inventory and accounts payable to some extent, we could apply here. And then there's deferred revenue. Deferred revenue is a really interesting one. It's really interesting because it applies, for example, for services or for stuff of that nature. If, for example, let's say you sell a service like myself back in the days where I would tutor students. Sometimes students would not need to, but would decide to pay me upfront. Okay, let's say that they decided to pay me upfront $100 before I taught them. Well, if you understand the revenue recognition principle and all that good stuff, you would understand that because I didn't teach them yet, because I didn't fulfill the service that they paid me for yet, well, I can't realize this as being revenue. I can only realize this as being deferred revenue, such that I would credit my deferred revenue because I have a future obligation towards my students, and I would debit $100, let's say that's the example, for cash, such that I'm able to balance my equation. So deferred revenue is another type of liability that you may have. It's usually a short-term one, because nobody would pay you 2 years before they actually give you the stuff, right? Unless you're looking at real estate, which is a different type of business, or if you're looking at cars, so pre-purchase on cars, if you're looking at deposits on 2-year leases, it gets strange there. But the idea here is that for just simple examples, deferred revenue is an obligation towards your customers because you need to provide a service to them into the future, but they decided to pay you in cash today. So these are a bunch of different liabilities, current liabilities that you may see, just so you get some context. Now, what I want you to understand, and it goes back to our example that we have highlighted at the bottom here, is that if we have a year-over-year increase in current liabilities, well, this is going to result in a positive effect on our cash holdings, okay? And the reason why this results in a positive effect on our cash holdings is because, well, dude, you didn't pay your supplier in cash. You didn't fulfill an obligation, okay? But you got to essentially save your resources, save your time. You got to put your time elsewhere, but you still got paid for a service before, okay? You had to pay, your suppliers, but you decided not to, or you just didn't do it yet, such that you get to keep your cash. So an increase in current liabilities actually kind of has a positive effect on your cash holdings. And the reason why it has a positive effect on your cash holdings is because, well, sometimes, if you just think about it, it would mean that you didn't actually have an expense that occurred. Okay, that's the best way to look at it. Now, conversely, a year-to-year decrease in current liabilities will result in a negative effect on cash holdings. And the reason why it's going to result in a negative effect on cash holdings is because if you got a current liability, okay, that decreased, such as a payable, right? This payable that we have right here? Well, when this payable gets eliminated, when that obligation, that liability gets debited, well, I had to pay my supplier somehow. I had to pay them in cash. So if my current liabilities are decreasing, well, it means I had to pay some cash. Some cash had to get out of the business, okay? And for that reason, that's going to have a negative effect on cash holdings. Of course, cash is being eliminated, all right? Now, we won't go into the proof within the statements and everything, but you can actually visualize that as well. So that said, let's look at an example, voice crack, my bad. Let's look at an example with Microsoft, okay? And we're going to look at what would happen at Microsoft if its accounts payables increased by $100 million from 2021 to 2022. Well, this would mean that they would have a positive effect to their cash holdings because they did not pay for a liability, right? For whatever they purchased, all right? They did not pay for it. They built a liability instead. For that reason, this would mean that they saved $100 million, okay? And this is a really good definition here, is that this would indicate that a portion of Microsoft's purchases were not paid in cash upfront. And in plain English, Microsoft didn't pay $100 million in cash, although they may have recognized the expenses, attached to that for that amount on their income statement. That's another good way to look at it. Right? So they did not pay for cash. And what's awesome here is that everything that we just talked about are things that we've seen in our intro to financial accounting class. This is being shown in our statement of cash flows, right? An increase in current liabilities and a decrease in current liabilities. Well, they have kind of like indirect effects to our cash holdings. That's the indirect method in our statement of cash flows. So now we know, okay? Now we understand, well, what does an increase in current assets do and what does an increase in current liabilities do, okay? So if our current assets are large, okay, and our current liabilities are smaller than our current assets, this would mean that we would have a difference between our current assets and our current liabilities. But we know now that positive numbers of like a positive value for our current assets, well, it actually doesn't indicate that we have cash. It actually means that cash is being trapped in the business, okay? That cash is actually being overstated and that we don't actually have that cash to work with right now. And current liabilities, conversely, well, if they're a nice number, a bigger number, if they're increasing, well, it means that we're essentially able to kind of keep that cash working with us. We're able to run with that cash. So what's awesome here is that if we look at current assets less current liabilities, well, we're able to really highlight the net effect to our cash within a given year or a given operating cycle. We're really able to understand, well, where is our cash right now? And if you kind of get a sense of this, is that, well, typically your current assets will be smaller than your current liabilities. And with that, you're able to understand that some cash is being lost in the business. Some cash is being trapped into a given project, right? And that's why I highlighted this here, and I'll put it in green, is that the net working capital formula is a very good method to highlight how much cash is being trapped in a business's current operations, or how much cash is trapped in a business's project or a new project, right? Because you know that a new project will require a different set of current assets and a different set of current liabilities. And the difference between the two will highlight how much actual cash is being invested actively or is being trapped or is within the cycle of that project, okay? So that's important to understand. And that's why on exams, on exam-like questions, or just within your courses, if you paid attention a little bit there, they would say that some projects will require a immediate initial investment in net working capital, okay? That's important because that immediate net working capital investment within the project was really gonna highlight current assets minus current liabilities, okay? So with that said, we understand now if we go to our change in net working capital, so what's on the right-hand side, is we understand that, okay, net working capital, it can be expressed as a net impact to our cash for a company, okay? So we know that, well, if we have a positive net working capital, well, this would mean that we have a negative effect to cash, right? Because this would mean that our current assets are bigger than our current liabilities. And we know that bigger current assets is no bueno realistically for our cash. It's saying that we have less cash than we actually do because we're overstating this stuff, all right? And we know that a negative net working capital, well, technically that indicates a positive effect on cash holdings, okay? But here's where the magic happens. Because on a year-to-year, just in a silo, if we look at 1 year, the net working capital, well, it's not really gonna tell us how much, what's going on with the flow of cash within the business. But if we look at the change in net working capital, for example, 2020 to 2021, and we notice that our net working capital actually decreased, well, that's gonna really ring some bells for us. Because if we have a year-to-year decrease in net working capital, well, this indicates that less money is being trapped in our business, that more money essentially was able to get freed up from the business. And that's actually a positive cash inflow. It's a positive cash value. It's a positive effect to cash. But if our net working capital increases, well, that means that more current assets, more cash is being lost and trapped in the business to be able to fuel the project, okay? And that's why that change in net working capital is an extremely valuable tool, because it helps us understand, well, what is the movement of cash for this project, for our current operations on a year-to-year basis, And hopefully the following bullet points will help you kind of understand what I mean. And then of course, our little Excel example, as well as our timeline, will really try to draw upon that, like that framework that we established, or that context that we built. So a year-to-year increase in the NWC is going to result, of course, in a negative effect to cash holdings. So in other words, I want you to think of an increase to net working capital from a year to year. So the change in net working capital to be, if it's positive, I want you to think about it as an indication, okay, that more cash had to be invested in the current operations of the business, okay? More cash is being invested in the current operations of the business, or more cash is being lost in the operations of the business. There's two frameworks to apply here. Think about it with me. So let's say that our inventory, because our business is growing and because we know we have more demand, well, we require more inventory. So for example, our $100 that we had here, well, now it's like $400, okay? We need more out there, okay? That would mean, assuming that this is cash, that we would require more cash to be spent in the business. In other words, if our current assets like inventory or merchandise increases, well, that means that more cash had to be invested in the business, okay? Another perspective to take here is that, well, let's say our accounts receivables, well, that increased from a year to year because we have more clients, but less of our clients are willing to pay. Well, that would mean that, more money is being trapped in your business. You're supposed to be making that cash, but you didn't make it, all right? So that's a way to look at it. So more cash is either invested into the operations or more cash is being kind of trapped or lost in the operations. And the key takeaway would be that, well, for all intents and purposes, on a year-to-year basis, if that happens, that means that cash was lost, right? If your inventory accounts increases, that means that you had to pay for that inventory somehow. And that somehow is through cash, assuming like a normal business, and that you pay your payables. So if we look at a decrease to net working capital, so a year-to-year decrease in net working capital, well, that, once again, it indicates a positive effect on our cash holdings. So we have here a positive effect on our cash holdings. And I want you to think of a decrease to net working capital as an indication that less cash had to be invested in the current operations of the business. For example, your inventory requirements are decreasing. Maybe you're more fast with your inventory. Or for example, your accounts receivables decreased such that you're getting your money better. You're actually like not losing money that's being trapped in the business. So understanding that is very important because that change in net working capital, a decrease in net working capital, well, it can indicate a few things on the side of your current assets and on the side of your current liabilities. But grosso modo, overall, it really does indicate that less cash is being trapped in the business and that less cash is being lost in the current operations of the business. So here's another point. You could also think of a decrease in NWC as an indication that, once again, that less cash was trapped in the current operations. And this would indicate that, okay, cash is retrieved or gained on that year-to-year basis. And once again, that's why change in net working capital is so important. So the reason why that's important, and I'm sorry if I'm like losing my voice a little bit. I'm like excited for y'all because I think you're learning, okay? A change in net working capital, well, it can be considered as a cash outflow or a cash inflow, right? Depending on the nature of the sign. And that's why these 2 points here are so crucial because we see that, okay, well, if we have an increase in NWC, well, of course, this is going to be a cash outflow. But if we have a decrease in NWC on a year-to-year basis, this would indicate a cash inflow because we were able to retrieve cash, okay? Now, sometimes NWC will require an immediate initial investment, all right? And I want you to understand that in a question, if they tell you, NWC requires an immediate initial investment, that value, all right, at year 0 will have to be negative. So if a question says, for example, you need to invest $75K immediately into the project through net working capital, well, this would mean that this is minus $75K, all right? Very, very, very important. However, sometimes you will see some change in net working capital depending on the requirements on a year-to-year basis, right? And that would indicate that you either have some cash inflows or cash outflows throughout the project. And those cash outflows and those cash inflows, well, they have to be discounted to T0, every single one of them individually, okay? So because the change at net working capital at the end of year 1, or at the end of year 2, or whatever the case may be, well, they're not happening today. And we need to account for those losses or those gains, and we need to discount them back to PV0. So that's kind of like the main points related to the context NWC and the change in NWC. Now, with that said, I want to walk through a quick like Excel example. It's on this paper here, and hopefully that could kind of like tie a bow on everything we just discussed. Sorry, I'm losing my voice a little bit. So on the screen now, you see 5 years. You see year 0 all the way to year 5, right? And those are displayed through different columns. Then you'll see different rows. You'll see 1, current assets, 2, current liabilities, and 3, net working capital, and 4, the change in net working capital, which is what we really care about. So what's awesome here is that, of course, you notice that our net working capital, if you do the math yourself, you could do, for example, current assets minus current liabilities, and you're going to get your net working capital, which is A minus B there, if you want to simplify it. And what's awesome is that the rule that I just mentioned, that immediate investment in NWC at year 0, well, that number is always going to be negative because you're just going to do 0 minus 100 type of thing, okay? That's the framework that I want you to apply. So it's always going to be a negative value. You can either do it from a math perspective or you can do it just to a rule perspective. But then after that, from year 0 to year 1, well, we notice that we have a decrease in NWC, such that we know that a decrease in NWC, well, that could indicate a few things, right? That could indicate that, for example, we're being more efficient with our accounts receivables, or that we're spending less, lost money in inventory. And that would essentially mean that less cash is being trapped in the business, or that we're retrieving more cash on a year-to-year basis. And that is not being expressed through our financial statements. And that's why we're going to highlight that change in net working capital as being something that's positive for us. So a decrease in NWC is essentially a good thing for us, is that our change in net working capital would be a positive value here. Okay, so here we would have a minus, here we would have a plus. Okay, and then if we look at year 1 to year 2, we notice that it's 75 and 75, right? They're the same value. So the change in net working capital from year 1 to year 2 is equal to $0. However, at year 3, we notice that our NWC will increased, all right? Almost twice the same, the previous value. And in this case, our NWC increased, okay? Which is what I just said, but that indicates that we have a negative change in net working capital, all right? We have minus 70. And we have minus 70 for all those 3 years. And these increases in NWC, well, that's a bad thing for us because it means that more money is being trapped in the business. And that's why when we look for a change in the working capital, we get negative values on year 3, year 4, and year 5. For that reason, we understand now that for some years, well, the change is positive, and in some years the change is negative, right? It has no impact at year 2 for us. However, at year 3, well, that increase in NWC, that has a negative impact for us because that means more money is being lost. For that reason, we have minus 70 for those years. Now, once you find all of those values, right? You found a value for year 0 all the way to the value for year 5. What I need you to do now is to understand, well, hey, those cash flows are occurring either right now, if it's at year 0, or into the future from year 1 to year 5. Well, those cash flows, they have to be discounted. And that's exactly what we did here. Notice how we're going to take all of these cash flows one by one, and we're going to discount them. Of course, by now, I hope it's clear. Cash flows at year 0 don't need to be discounted, but the rest they do. And then essentially what I'm going to want you to do is just sum them up. And that's going to give you your present value for your net working capital, or your change in net working capital. Now, this was a lengthy process. We talked about a lot of things, but what's awesome here is that the more questions you do and the more you walk through this concept, and honestly, the more you look at other videos other than myself, you'll be able to really get a good sense of what NWC is. And this may not be the solution, right? So you to really feel like you know everything here, but hopefully it's like one step towards that, okay? So with that said, I'm gonna drink a little bit of water, and we're gonna move towards getting our portion on on our net working capital recapture. And what's awesome here is that this is going to be super straightforward. All right, it's very easy. It doesn't take too much like heavy lifting on your behalf. All right, so notice how there's almost nothing on the screen now because it gets really easy. And we're going to walk through this, and hopefully, once again, with the information that was provided prior to this portion here of NWCR, you'll be able to really understand this. I'm sorry that my voice is cracking. I guess I didn't plan this as, I didn't think it would be as long, or I guess I didn't eat enough, or I didn't drink enough, or whatever the case may be. But that said, I'm still super excited because I really think that this is something that all of you students would need, right? It's something that I would have wanted if I would have taken the course. And hopefully I'm able to like low-key explain things correctly. I don't know. All right, that said, net working capital recapture. So once again, we understand now that, well, the net working capital just net working capital, right, is money that's being lost in the business. And that's why we look at the change in net working capital to figure out, well, how much more money is being lost in the business, or how much money did we retrieve that was lost, right? That's kind of like the way we're looking at it. Now, the thing is here is that once a project is finished, or once a division of a business is terminated, well, all of the net working capital attached to that business in an ideal world, well, it's now no longer, it doesn't need to exist anymore. And when it doesn't need to exist anymore, we could essentially retrieve it. We could recapture all of the net working capital into that business, into that like portion of the business or the project. So what we could coin this as is we could say that the net working capital recapture is just us retrieving, okay, and I'll highlight it here. It's us or the business retrieving all of the cash that was trapped in the current operations or projects of the company. All right. So this is why on exam questions, they'll say, hey, at the end of the project, the firm will be able to recapture all of their net working capital. All right. But what I want you to remember here is that what you're going to recapture is not essentially the singular value that you have here at year 5. You're going to recapture the sum of all the change in net working capital. Okay. Because some of the money along the way was retrieved and some of the money along the way was added. So you don't want to find one singular net working capital. You want to find all of the change in net working capital as being your amount. Now, this is probably the best way that I would look at it, okay? So with that said, net working capital will typically consist of a cash inflow, all right? It will typically consist of a cash inflow, and for that reason, it'll be a positive value. And this is interesting because once we get to the end of all of these buckets, you'll understand that there's only really like maybe 1 or 2 cash outflows, and the rest is all cash inflows. So that's pretty interesting. And the net working capital recapture is generally going to consist of a lump sum at the end of the project, okay? And therefore, it's going to require discounting because that cash flow, as you can see on our timeline, assuming that it finishes at year 5, right, the project, that cash flow, that net working capital cash flow that you're going to recapture at year 5, well, it's not happening today. And because of that, we got to discount it all the way back to T0. All right, it's as easy as that. So it'll require discounting. Now, just for some additional context, and I'll give you like a perspective, and there's 2 types of recaptures that you may have. Okay, some projects or some questions, they may have just a net working capital value for year 1, and some projects will have net working capital from year 1 all the way year 0, sorry, all the way from year 0 all the way to the end of the project. So we'll call this at end. If your net working capital was just an initial, investment that was required, for example, let's say, I don't know, let's call it $75,000, okay, that was required at the very beginning, well then you're going to retrieve that amount at the end of the project. So that 75K would be retrieved at year 5. Now, because that 75K is being retrieved, so you're getting that money back, right, is going to be a positive value, but that positive value has to be discounted all the way back to year 0, okay? So it's going to be discounted for 5 periods. And the present value of your recapture will be smaller, right, than the initial investment required. Now, in some cases, you may have problems like this, where it was minus $100 at year 0, $25 at year 1, 0 at year 2, minus 70, minus 70, minus 70 from year 3 to year 5, okay? Well, in those types of questions, what's important here is that I want you to understand that you're not just going to recapture the minus 100 that you had at the very beginning. Okay, you're not just going to recapture that. And you're also not just going to recapture the $285 that you're going to get at the end. What you're going to recapture is pretty interesting, is you're going to recapture the sum of all of those, okay? So if you add up all of your individual change in net working capital, you'll be able to understand, you'll be able to retrieve that amount, okay? So it's going to be the sum of all those individual change in NWCs that you found. The reason why that's the case is because, as you can notice, is that, well, you had an initial investment in net working capital. In this case, it was minus 100. But then you were able to actually have a change in net working capital that's $25. What we're trying to figure out here is that you're going to recapture all of the cash, okay, that was lost into the business. But sometimes some of that cash was retrieved, and at sometimes some of that cash was also essentially added. So more cash was lost into the business. And it's not just once that cash is either being lost or retrieved. It's happening multiple times every single year, and sometimes in different amounts. And that's why we're going to add all of them up together. And what's left, either positive or negative, is what we're going to retrieve. Of course, if the total sum of the change in net working capital is negative, that means that there's still some money being lost in the business. And we're going to retrieve that, and it's going to give us a positive value. But if the sum of all the net working capital is essentially a positive, well, that's usually never going to happen, but that would mean that you would have a negative value. But that's almost never the case. We're going to look at the normal case at which the sum of your change in net working capital is a negative amount, and that amount you're going to retrieve as a positive. It's going to be a positive value because you're going to essentially retrieve all the money that was lost into the business all together, okay? And I guess there's another proof that we could go through, is that you notice how net working capital right here increased by 185, right, total. But what's awesome here is that you see as well that, well, although it did increase by 185 total, we also know that the amount is equal to 285, right? And if you add all these numbers together, I'm going to do some quick math in my head. You're going to get 210, right? Minus 70, minus 70, minus 70. Plus, with this, you're going to have minus 100. You're going to have minus 310. I'm doing some quick math. And then this plus 25, you're going to get 285. And what's hilarious is that actually you're going to retrieve the last amount at the end of the project. Oh, look at that, quick proof. Sometimes you could actually do that. I've never actually done the proof, so I'm gonna have to check it out later. But still, the best practice is just to say that you're gonna take the sum of all these, but it seems like you could also just take the final value of net working capital. But it's not always the case. This is a very specific example where there's no net working capital prior. But anyways, just some additional context. Even me, I'm learning every single day, right? So that's pretty awesome. Anyways, that said, those are the two methods that you take. I'm very open to like having a conversation about this later on though.